Hi, everyone, and welcome to this month's edition of On Track. It's April 29th as I record this. I'm in the Northern Hemisphere. I'm actually sitting in port at a little island in Croatia. I'm on a month's sort of travel, still working on some key parts, particularly care. We had our investment committee last week while I was in Milan, but I'll bring you all the news up to date um, to today and all the performance numbers and economic numbers up to the end of March. And what a month it's been. And I'll dive into that in a minute. But before I do, as usual, a general advice warning. All of the information in these videos is designed for clients of McGregor Wealth Management, particularly those that use our care investment methodology and process. For anyone else that watches these, you should seek out advice that's suitable to our needs before you act on anything. So let me dive in. We're going to cover all the economic news, and there's lots of it. There's very much a single focus. It's Trump, 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 Trump. I'm going to talk about the swings the market's had, and they haven't been as crazy as the media is making out, but they're still significant, but not. And I'll go through and quantify that as well. The portfolios are holding up really well. We've made a couple of good moves in the active portfolio, so we've done better than most as well. So let me dive in. And yeah, the headlines, as I summarized it, sitting down about the last months, the markets are bouncing around. I threw in down the bottom here two charts of the last 6 months in the Aussie market, and you can see we're kind of where we started 6 months ago. And we've had dividends on top of that, so it's not too bad. We were up at a high of around 8,500. At the peak of the downturn, we dropped down to as low as 7,300, but it's quickly bounced back. And as I record this, the market yesterday in Australia closed at 8,070. NASDAQ, which is where all the ups had been in the last year, it had a drop from about 20,000 down to almost 15,000. So a significant drop. 20% constitutes a bear market. 10% is a correction. Australia didn't quite go to 20%. NASDAQ just went over 20%. And the S&P 500, the US, didn't quite do 20%, but everything's back up. So it's not down that much now, and most things are kind of back to where they were 6 to 8 months ago. So yeah, all based off the Trump news cycle. Yeah, we've got an election going in Australia, but it's a bit of a yawn. I'm away from the country, but I'm watching all the news, and I've got to say it doesn't look like very inspiring choices with both parties pork barreling, both parties offering minor things, but no one offering any real long-term vision. Yeah, it's a bit of a non-event market-wise and economic-wise, and yeah, there's no major damage will be done either, but neither will there be anything inspirational. We'll see what happens next week. Um, yeah, all the economic news out of the States is driven by the Trump news cycle around tariffs, etc. Economists have moved to being fairly optimistic to now thinking we might, in the US at least, get a shallow recession off the back of US consumer confidence, which is dropped because of the trade war. So for US consumers, they're looking at the costs of lots of things that are imported into the States going up. That's created a bit of a argy-bargy between Trump and the chairman of the Fed, which is the Federal Reserve, that sets interest rates in an attempt to stabilize the economy. And their chairman, Powell, who's a very steady, safe pair of hands, has been. Trump's been threatening, making all sorts of rants. That he can sack him. Powell will finish his tenure next year in March 26. So I think Trump will pull his head in. The market did a severe drop when Trump had a rant about Powell. The market is the only thing keeping Trump accountable at the moment. The media is too diverse, too spread. There's no elections for a while. So Trump respects the market. He changed his mind on the tariffs when the market dropped and when bond yields spiked. And I'll talk more about the whole Trump thing in a minute. It's very easy for this to dominate all conversations at the moment. There's been lots of volatility, but as I said, it's not a significant bear market. And I'll go to my chart in a minute for the last 20 years to show how it fits in. But it's all over the news, and it's hard not to look. I must admit, find myself looking every day at the US and what's happening and seeing how the market's reacted. And it's volatile. It's been up and down, as you can see from those bottom charts. One of the winners out of all this has been gold. And you'll see when we come to the performance numbers, gold's just continues to go from strength to strength. I'm very happy to have gold in the portfolio. No change in our RBA. So to the numbers on the right here, no change to the RBA cash rate. The markets were expecting drops of maybe 0.5% coming up quickly. Everything's not so sure at the moment because we're not sure about tariff wars and inflation, etc. So I'd probably expect that to be on hold for a little bit longer. Maybe we get a quarter. It'll depend on economic figures as well. 90-day bank bills have dropped a fraction, down from 4.06 to 3.92. 10-year government bond yields have dropped a fraction, but not much. They're still in that zone. The Aussie dollar, it dropped as low as 59 cents, but it's back up to 64. So it's maintained reasonable value in this little up and down volatile period. We're waiting for the Australian inflation numbers. We don't have an update from last month yet, but still in that 2.4%, albeit slightly artificial 2.4% because of the energy subsidies from the Albanese government. US inflation is back in the middle of the zone. So in any other scenario, they would be looking at dropping cash rates because inflation's back in the bottle, so to speak, the inflation genie back in the bottle. But just as it's back in the bottle, along comes tariffs, and that would cause price rises. This is interesting though, because it's only in America. Now, Australia will have very little impact in terms of inflation from the tariffs. So we may have an impact from lower world growth, etc. And if China's weak, Australia always suffers a bit. But there's lots going on. I'll unpack that in a minute. No real change to mortgage rates. We're starting to see 1-year term deposit rates drop because of that expectation that rates are going to go down. The portfolio returns, keep in mind, at the end of March, we were lower than where we were. So this is probably the worst of it. And you can see the 1-month figures down 3% on the high growth, 1%. So not terrible. International equities down the worst. But as you go out to 1 year, the 1-year returns are still at 5%. So they're okay. They're not where we want them to be, and they're not going to stay there because that's at the bottom of the ditch. And you can see as we go out to long-term returns, 7 and 10 years, they're well and truly in that target range that we do. 2 investment committee meetings ago, we dropped a dial to an 8, so just a little bit above fair value. We reaffirmed that last week when we met again. Had we been meeting at the bottom of the markets, we probably would have had the market at fair value, but the rebounds popped it just over fair. We're always happy to be buyers just over fair. This is not a precise science. So anything in that middle range is okay buying. For a lot of our clients where we're averaging in at the moment, we took advantage of the dips and managed a few extra buying of the dips. So yeah, and that's the key, is to be proactive. So you can see on the right-hand side where this fits in. You can see my updated headline here. I've had for the last 3 years, 6 downturns since the GFC of sort of more than 12%. And you can see we've now added another one, so there's 7. So this one, which will probably be known as the Trump tariff tantrums, but it's just another one of all these other valleys of fear. As we talk about our wall of worry, and the market climbs the wall of worry, but it goes through these persistent valleys of fear, and we come out of them. That's the important point over that. Nearly 20 years of this chart, we see the market double plus dividends in spite of all of these cycles. This one feels like it was worse than the other similar ones of 14, 15, 12%, but they all do at the time, and then we forget what caused them later. In Trump's first term, we had a drop of 17%. Which was fear of, so back in 2019, fear of tightening of interest rates plus trade wars. So there's always a reason after the event, but I'm not concerned about this one. And I'll talk a bit more about the Trump thing right now. So there's 4 things, and it's a hard one to understand. And most of the media is biased one way or the other on this stuff. So they report on this depending on whether they hate Trump, whether they love him. And unfortunately, in Australia, most people are agnostic. We're watching this and going, this is crazy. There's less people probably think Trump's doing an awesome job than there was a few months ago, because this does seem a bit trady. But let me try and unpack what he's trying to do. At the heart of this, the US government carries too much debt. The US government's debt to GDP ratio, so that's government debt to the national income, is about 146%. To put it in context, Australia's about 42%, so much lower. the US is adding to it at 5% a year. So within what do we got? Within 10 years, they'd be at 200%, which is really Banana Republic type area. So someone's got to do something, and no side of government's been willing to do much about it. And because they're adding to it each year, it's a slippery slope. It just gets worse and worse and worse. And think about debt and what happens when interest rate rises. So interest rates were low. So a lot of the government debt was fixed in the last 10 years during COVID and around it when interest rates were 1 or 2%. But in the next 2 years, there's a lot of those 10-year government bonds to be renewed, and they're going to be done at rates of 4% if it stays where it is and higher. So that's going to double the amount of interest that the US government is paying. And these are massive amounts of money. They're in the trillions of dollars. So at the heart of this, just like you and I, if our budget's not balancing, someone's got to do something about it. So the only way you do something about it is to raise your income, which is taxes, or reduce your spending. And we're seeing a bit of both of that from Trump and co with Doge, however you pronounce that, and Elon Musk trying to cut government spending. And the tariffs will increase revenue, but also, Trump does want to cut taxes as well. So that will reduce revenue. So that's kind of at the heart of it. But then he's talking about a few elephants in the room. So firstly, let me go to the bottom left-hand corner. The US, since World War II, has pretty much been the paternal big brother of the free world. Look at us in Australia, places like New Zealand, Canada. We kind of know the US would stick up for us in the event of us having some sort of dispute or war, but we haven't really had to pay for that. Now, it's not just that black and white. So Australia has a lot of land allocated to US defense facilities, the same as other countries, including Canada, Japan, South Korea, lots of Europe, etc., the whole NATO connections. But the US spends 5% or more of their GDP on defense, and most European countries and Australia are sub 2%. So Trump's the first one to stand up and say, hey, we're not happy to be paying for protecting all you guys. Now, he's done it in a way which is very confrontational. I don't think it's very healthy for the relationships of all the allies in this sort of thing. And it's all of a sudden, even their next door neighbor, Canada, is feeling like a threatened neighbor. It's quite extraordinary to watch. Now, the thing with Trump is you never know whether he's trying to do a deal, and his art of doing deals, of which he wrote a book about 20 odd years ago, is about going in hard on something and then negotiating backwards. So, and this is what we're seeing with the tariffs, putting in these rates and then bringing it back. But the challenge for markets and for other countries dealing with Trump is it's hard to tell what he's actually trying to do. Now, at the top here, we have the other problem of the US trade deficit. So the trade deficit just means if a country has a deficit, it means they import more goods than they export. And if you import more goods than you export, you've got to effectively borrow money. You've got to have money flowing into the country from overseas. So, the biggest nations, the biggest countries that have lent their money, so to speak, to fund that trade deficit are countries like China, Japan, South Korea. Now, they have an interesting challenge because on the one hand, he needs those people to be buying US dollars to keep the dollar up. But the dollar up also makes it more expensive for US exports. So this fine balancing act where he's saying, hey, all you guys, we've got these deficits. We're going to put tariffs on you to even it up. Now, the two are not connected. The logic is not good. You may have read about this in some of the things. But what he's done is he's now negotiating in theory with 90 to 200, not he, but his team are negotiating with 90 to 200 countries on trade imperfections. So no, we don't have truly free trade. A lot of what he's talking about is not imperfections in free trade, but there are some. So who knows what that's going to bring. He's left the high tariffs on China, and my last of the 4 points is China's power is rising. And this is interesting to watch because on the one hand, Trump's trying to reduce China's power by evening up the trade deficits, etc. But he's forcing some of these allied previous partners to look more at trading with China. So if Trump persisted with these high tariffs, you would see people like Europe, England, Australia try and do more trade with China and other places they could not now do with the US. I don't think it's going to come to that. And this is why the markets are bouncing back, because they're going, well, this is partly a negotiation tactic, but the challenge is it's very hard to predict. So the headline I had there, Trump dropping bombs at unprecedented level. Those bombs are these threats of tariffs. But what he's trying to do is fix those problems. He doesn't want he doesn't want the US to have to keep funding this because they're going broke. Now they're not going broke in a hurry, but they're slowly going broke because they keep adding to their debt. So he needs the rest of the world to pay more for the defense of the world. And yeah, the same with the trade deficits. But it's a fascinating way to watch, and it's very hard to know from day to day how it finishes. But keep in mind, yeah, when we get hyper focused on things like this, we forget that every day we get up, we go to the supermarket, we buy our groceries, we do the same level of spending that we do for the most part, and that keeps the share market and the economy going. And that's what we're seeing. So, and I will just say these volatile times are actually good for us and our clients, just in the way we manage portfolios using the care process. So, and I will remind you of this again, because it is important. It does help. Hopefully you keep very calm in these roller coaster times. But firstly, just the massive diversification we have, and we're rebalancing. So at the investment committee, a couple of weeks ago, we rebalanced the portfolios. That means we buy a bit more of what's gone down. And if you picture that chart from back of that first page, so when that was at the bottom, we were buying more of those things, and they inevitably go up. So that means we've added value through that rebalancing. The third bit there are the tactical adjustments. We took a profit in the active portfolio at the start of this tariff talks. We got back in partially at the bottom of the market. So we've saved our clients in the active portfolio, which is most ones 6%. We've done 6% better than the market during that period, just by applying our principles. Now, we don't do that often. We only do that literally in the last decade. We've taken actions like that about 5 times, but it adds massively to the performance over time. And it's something that we only do that in the active portfolio, and we rebalance the core portfolios. Reserves portfolios, all of our clients are nicely topped up with reserves because we've had a good market. It means we don't even have to think about selling any of the good stuff for 3 to 5 years. And that gives us time to get through these things completely. For our accumulators, this is Christmas time. All these ups and downs are just big specials for you to buy cheaply markets during these dips. So for those dollar cost averaging, all our wealth accumulators who are yet to retire, these are good times for buying the dips. And then we'll get back above where it was, as always. And for our clients that are putting new money in, and the money on the move framework we have with this dial, that's allowed us to be putting money in slowly. Going back to December before all this happened, we were spreading money out over a long period of time, over a year at least, and we bought some of those forward and bought some of these dips. So the system is working well. Nothing too much changing in the bond yields. You can see on the bottom lines here, it's just rotating up and down a bit. And when the bond yields spike, that causes havoc to the share markets, and that's what caused Trump to back down on the last bit of tariffs and give a 3-month moratorium while they're doing all these negotiations. Who knows what's going to happen? But the markets have sort of jumped up thinking, yeah, they're going to work out some sort of deals. The wall of worry framework, perfectly descriptive at the moment. You can see that model of boom bust and wall of worry, and all these little ups and downs. They're the 10, 12%ers that I showed you a minute ago. This is just another one. None of them are memorable in the long run. They're just all speed bumps on the way to prosperity for the markets. No change in the dial. I won't go into that. I've lit up most of the things here, the top 4 at least, in how people mess up their investing, and they're all at play at the moment. The media is going crazy on this. They love this story every day. There's headlines: Trump this, Trump that, tariffs, wars, and it just gets everyone worked up and worried. But that's their job, to get everyone worried. And you want to be careful you don't get too caught up in it. I try and take a balance of being interested but not worried by it. And my job and our job as the Care Investment Key is to be vigilant on it, concerned, but not too gloomy, because we know that costs us money, because we're emotional creatures. And when all this stuff is going that looks crazy, it's often tempting to want to do something, which is, if you're already invested, the only thing you can do is to get out, and it's highly dangerous at these times. And once again, the short-term focus and the single issue obsession. This is a massive single issue obsession. The whole Trump thing, it's bizarre that we've only had 100 days of Trump. That's 3 months. So we've got 16 more 100 days of Trump, and it's going to be fascinating. But the people that have strong investment strategies will prevail as always. I put this one in, so herd instinct or herd following as the behavioral bias of the month, and that's where people can tend to all act together with whatever it feels good to do. So herd instinct obviously is when people act as a herd. So everyone's selling, everyone wants to sell, whether it's panic selling or buying in bubbles. And we're seeing bits of that. Although I've got to admit, I don't think these downturns, although there's been volatility, in my experience, this isn't a crazy, unprecedented volatility. It's normal market volatility that you get when there's changing of times, and they tends to then settle, and we get on our merry way, unless there's a severe interruption to economic prosperity, and maybe we get a little recession in the States. But as I've talked about, a recession is just 2 negative quarters of GDP. A shallow recession. So if you the simplest way to think about a recession is pretend a country is just like you or someone like you. And let's say that country was earning 100,000 a year. During a recession, it might drop to 99,000 a year. So you're not broke. You've still got money. You've got to pull your head in a bit. But what's the beauty of a recession? They drop interest rates. Interest rates go down. And then it's the start of the next cycle. So I don't mind a little recession. It often means we can bring interest rates down and the next cycle can begin, which is usually a prosperous time for investors. I've highlighted here for this month just these pillars that we've been busy with, making sure we stay appropriately diversified by rebalancing, avoiding bad decisions by communicating as we do. And yeah, I've got to once again congratulate all our clients and investors for not being panickers. We don't get loads of phone calls. I know some of you check your investments a bit more than you probably would, but I know part of that's because you're interested, and part of this video each month is trying to put everything into the long-term context so that you guys don't mess it up. But the last one I've highlighted there is just volatility is inevitable. This is normal, inevitable. These are crazy times, but the market has a way of just working it out in the long run. You can see the impact when we look at the Aussie share market was down 3.3% for that month. That was a dip. It's bounced back up again, more so than some of these charts I did a few days ago. We've bought the market. Our assessment of just over fair value for the Aussie market's pretty close. We've got fair value at about 7.6, 7.7. It was below that briefly, but it's gone back up to 8,000. But it's still reasonable buying. US shares, we had it expensive. They've come back a fair bit. You can see, and but have a look at the bottom right-hand corner on these charts, and you can see that from the top, they've come back, but it's only about 6 to 8 months. And since I printed these ones, they've bounced a fraction as well, so it's not even as bad. And those little dips, they're normal. You can just see so many of them on the way. Ironically, the big seven that we talked about all last year, Apple, Microsoft, etc., they've dropped by more than the markets. So they've led this downturn because they're right at the heart of trade wars and other things, which is probably a good thing. Sometimes if markets like that run too hard, they run the risk of turning into a bubble, and that's always crazy. And then so having the heat come out of the market, I think is actually a good thing. And then it can slowly start to work its way up again. Global leaders are very similar to US shares because most of the global leaders are US shares, make no mistake. US small caps have copped it. It's turned into a bad year for them. This is at the end of March. They bounced a little, but yeah, back to 0% over the year. And I'll just go back. Global leaders are still 9% for the year, and US shares 12% for the year, so quite healthy. We go to emerging markets, and emerging markets have had a good year. Once again, this is why diversification is so important. Emerging markets 12.85% for the year. Gold 46% for the year. And after the end of the month, it actually spiked up higher before it's retreated a little bit. So gold, emerging markets, things that had been down the last few years have all of a sudden delivering well. And this is why diversification is so important. Into the property market, I've got less this month on that. I did want to focus on the Trump stuff for this month. but we're seeing a bit of a slowdown, and where all eyes are focused not so much on Trump for the Australian property market, but on where interest rates go is the critical one. So you can see Australia over the last year, on average, properties went up 0.7%, but very different stories in the cities and the country. But this is much less than it has been. So all of a sudden, and you can see that on the chart on the right, which is the rolling 12-month growth. And you can see it's down about 2.8% in the capitals, 5% in the regionals, but it's down from that period where it grew strongly post-COVID through to March 23. And it's settled. We're looking ahead to interest rates, and if interest rates were to drop 0.5%, that'll be positive for property markets. We're seeing record high rents, not going backwards, no chance at all, but it is slowing down a little, which is probably a good thing as well. But yeah, regional WA rents up 10% at the top end, slower in Canberra, ironically. But yeah, they're now into, most of them are just a little bit above inflation. It's not as crazy as it was the last 2 years. And there's nothing in this election from either side that's going to solve the housing crisis. The only long-term thing that solves it is better quicker quicker actions from local councils in freeing up land, freeing up zoning that allows properties to be split and things like that. And it's not always what people want to hear, which is why it's so hard. Nothing happening with mortgage rates, although the fixed rates have dropped a little. You can fix a 2-year rate now at sub 5.88%, but that's about where the best variable home. I'm not a fan of fixing right now unless you really want to lock in certainty. So whenever there's always two reasons to fix a rate. One is you're speculating the rates are going to go up and you want to lock it in, but the other is just insurance value. You just want to make sure you've got a rate in your budget for the next 1, 2, 3, 4, or 5 years. So sometimes that's a good thing. If you just want to know you've got it covered because you can afford it right now, you can lock in a rate. But it is still probable, but not guaranteed, that rates will drop by 0.5% or so this year. But there's so much going on, it's hard. If we did get a bout of inflation in the States, then it's not sure whether that would drop as quickly. But watch all these spaces. I added, as well as our friends from Performance Property and their property clock, I added the Heron Todd one, which we used to show a lot. Same, but different. There's always places that are going up. There's some on the decline, and Sydney and Melbourne are declining on both of these charts, but are slowing down and declining, but they're starting to get, particularly Melbourne is starting to get closer to potential value. And as always, if you're in the market for investment property, or if you're thinking about it, happy to talk to it. And we've relied a lot on our colleagues at Performance Property have done a wonderful job of steering our clients into good property acquisitions in the right regions. But yeah, generally when we've got an election like we've got at the moment, people tend to pause property decisions a little bit while they wait and see what happens to see if there's any changes. But it doesn't look like it's going to be much significant. So let me wrap up. Our core beliefs that investing is always best done as part of a real financial plan, and that's based on your goals, based on stuff that's important to you, portfolio designed to meet those goals. And then we take a long-term view, all the boring stuff that works beautifully: diversification, asset allocation, and liquidity. We get access to roughly 70% of the fund is mostly index. We take a little bit of active space where we have a certain view. We protect against short-term volatility with a variety of strategies. For our retired clients, that's the reserves. And for our wealth builders who are still working, it's dollar cost averaging. And it's been good times for that, the volatility, ironically. We rebalance regularly. There's no doubt we've made extra money in the last few months with this volatility from the rebalancing that we otherwise would not have without those dips and those opportunities. And let me just keep going. As always, I'll finish off. There's only 3 ways to lose money in the markets. And that is if you panic and sell, if you have to sell, and if you're not properly diversified. Our philosophy and our way we implement means you should never have to do that, which means you'll never lose money in the long run. These dips sometimes cause worry, but that's the price we pay for superior long-term returns. Thank you as always. I look forward to talking to you and seeing you at some stage soon. And yeah, enjoy the news for the entertainment value. Don't get too stressed about it. If ever you are, we're always happy to take a call and talk you through how it affects you personally. But it's not something we're greatly concerned about as long-term investors, but continue to expect some volatility in the short run. And that's it. Rob McGregor signing out.